so that it can be shared with your colleagues and other regulators who have been unable to attend today. We will then stop the recording once the presentation has finished and before we move to Q&A. Questions won't be recorded, notes or minutes won't be circulated, and we want this to feel like an informal session where conversation and questions are encouraged. So we're delighted that you've been able to join us today for our very first episode of our new educational webinar series for regulators. Not all blockchains are the same. This series will discuss facts from hype, differentiating from myth versus reality. In this series, we will unravel one blockchain at a time, exploring the purpose behind its development, the unique features, and how each addresses compliance and regulatory requirements. Our first session today will look at the Canton Network and regulatory compliant blockchains. You'll hear all about it shortly, but briefly, the Canton Network is a public permissioned blockchain network designed to uniquely address the need for interoperability across blockchain instances to enable the atomic transfer and synchronization of institutional assets, liabilities, and data without sacrificing the controls demanded by regulated financial markets. I'm delighted to be joined today by Yuval Ruz, co-founder and CEO of Digital Asset. Previously, Yuval served as both the CFO and COO. And prior to Digital Asset, Yuval held positions at Citadel and at DRW Trading, where he helped launch DRW Venture Capital. Yuval is a member of the Digital Assets Markets Subcommittee of the US Commodities Futures Trading Commission, CFTC, Global Market Advisory Committee, and is a frequent speaker at industry conferences. We're also joined today by Kelly Matheson. Kelly is the Chief Business Development Officer at Digital Asset, leading the team that provides strategic consultancy support and enables clients to use Digital Asset's technology and partner solutions to build the next generation of interconnected applications. She is also a member of Digital Asset's executive leadership team. And we'll also hear from Manoj Ramia, General Counsel at Digital Asset. Manoj has been practicing law for 15 years. He leads the legal and policy functions at Digital Asset and actively participates in the regulatory dialogue around digital asset innovation. Prior to joining Digital Asset, he spent almost a decade in private practice at firms including Kirkwood and Ellis and Goodwin Procter, representing technology companies and investors in strategic transactions. I'm going to hand over now to Yuval, and I do hope you enjoyed today's session.
Thank you, Emma, and thank you everyone for taking the time. I think that we're very excited about this series because I think that engaging with individuals such as yourself is extremely important, and it's extremely important that we all use the same language and make sure that we understand each other, because I think that the opportunity for financial services and also regulators is quite significant when it comes to this technology. That being said, as technology evolves and we have social networks, there's quite a lot of noise out there. And I think that in some cases it becomes really challenging understanding really what is the opportunity and where are the risks that exist as they exist with every technology innovation. So at Digital Asset, we started the company in 2014, and our view was, if you can create a global network like the internet that doesn't compromise privacy and control, there's a significant opportunity for financial services to reduce settlement risk, reduce operational costs by the eradication of reconciliation. And then also, as we see settlement times shrink and therefore increase the need for moving assets more efficiently, this technology also poses a very big opportunity for asset mobility, not just for settlement, but also as you think about collateral and mobilization of collateral globally, which again will have not only reduction in risk in the system, but also for the financial players will allow them to manage their capital more efficiently. And we always thought that these opportunities are very significant and are worth, now we're almost 10 years in this journey, are worth this investment, because it really sets financial markets for success for the next 100 years. And that's why we've been at it for so long. I think that the challenge, though, is as you're thinking about this technology, when you start thinking about financial services, there are a lot of regulations, and those regulations have been created over the years for many reasons, and they've been created based on experience and mistakes and challenges that have taken place in the past, and we learn from those challenges. So again, when we started the company, we really thought about how can you actually use this technology while meeting all the regulatory requirements as they exist today. And we're starting with this slide to just show that we believe a digital asset, that you can use blockchain technology and meet all regulatory requirements. So as you can see on the slide, this is just an example of some of the applications that are either in production. For the most part, everything here on the page is already in production, maybe with an exception of one or two. And all of these institutions are heavily regulated. They do need to meet, IOSCO rules. They in different countries have to meet all kinds of other regulatory requirements. And we believe that, that is possible, as you can see on the page. And I'm happy to go into some of these examples in details if anyone would have any interest. But this is just showing that there is quite a lot of interest in the technology, but also that the technology does actually provide a lot of efficiency for the market and an opportunity to drive financial markets forward. So if we move to the next slide. This is just another representation of just showing that, the opportunity with blockchain is not just around issuance. So recently we've heard a lot about tokenization and how we can issue and distribute assets, but it actually is across the entire value chain of capital markets. And later in this presentation, we're actually going to talk about a pilot that we've done. And I'm going to just give a quick preview. One of the things that we believe has been lost with blockchain is the understanding that as you start thinking about interoperability, and that's going to be an important component that we talk about between the differences of different blockchain, interoperability and being able to connect these projects is really the promise of blockchain. That's really the opportunity, is how do you connect all of these different applications across the value chain of capital markets in order to have stream through processing of financial transactions to enable shorter settlement times with no reconciliation and no breaks. So again, this is just another representation that there's quite a lot of opportunity for the technology, and it exists across the entire value chain of capital markets. So, I sometimes I like to take a step back and just make sure, and if this is very basic, and I apologize in advance, but really, why is there this opportunity for a new financial network? So in many applications, when you actually just zoom in on just one use case, there's quite a lot of opportunity to bring efficiency. So the system today operates with days of latency that are a direct result of messaging and reconciliation. And I want to explain that, because I think that this is a fundamental thing to understand when it comes to blockchain, is that when capital markets became electronic, the best way to reconcile or to have ledgers agree with one another to effectuate settlement or other financial transaction was via computer messages. So we know about SWIFT, FIX, FPML, all kinds of different types of messages. But messages have an inherent feature with them, which is you don't know if the counterparty that you sent the message to have actually did what they were supposed to do. All you can prove later on after the fact is that you did actually communicate the message You got an acknowledgement, but you couldn't actually prove that what was supposed to happen did happen. And this is really the only thing that blockchain offers on top of that, is really it's moving away from what we would call a message-based architecture into a state-based architecture, meaning when multiple parties are stakeholders to a transaction, they can always see the state of that transaction in real time. And this is what a lot of times you hear people talk as one source of truth. And that will, again, lead to lower reconciliation, less breaks, trade breaks. Just quick anecdote, as a result of T+1, there's a projection that breaks will go up by 50%. So really all it's offering is to have a much more real-time view of the world, and as a result of that, make markets more efficient. And if we stay on the previous slide for a second. So that's the left-hand side opportunity of blockchain. The second part is really that today connecting markets and different systems to one another is still very complicated. I'll just give the easiest example. There is no real DVP in financial services. We like to use that term, delivery versus payment, but actually delivery versus payment always exists with settlement risk. And that's why we still see settlement breaks today, meaning cash and assets don't live in the same network. And you do rely on third parties to connect those two systems together. And as a result of that, you have still a lot of inefficiency. And that inefficiency actually goes very much into settlement risk, which still exists in many, many systems and markets today. So the second opportunity of blockchain, assuming it's designed correctly, is really to offer a much better settlement rail across different assets and from cash into different assets. So those to me are the two most important opportunities when it comes to blockchain. Next slide. So, I think that the goal of this lecture is really talking about, not all blockchains are created equally. And what we mean by that is when you think about public blockchains today, and I think maybe I would make a change to this slide. If you look at the right-hand side at the top, it's really public permissionless. And I think that this is maybe one of the most important things that we want to talk about, is that till today, the word public blockchain was synonymous with permissionless. And what I mean by permissionless, there is no privacy inherent in the chain, and there are no built-in mechanisms to have control over assets. There's a lot of workarounds that have been created over the years, but there's no inherent technology built into the chain to really create control of assets and participants. And it's really, that's where the word permissionless came from. And one of the positive things that we saw is interoperability. So when we think about the word DeFi, for example, it really benefited from this idea of all assets existing on the same chain. This is just what I talked about in TradFi. You don't have DVP, is because the assets don't exist in the same network, where in public permissionless networks, you have all assets on the same chain. And as a result of that, you saw massive innovation, whether it's decentralized exchanges, all kinds of lending platforms that can actually pledge assets because they're all on the same network. The problem is, in order to build such a network that can do interoperability, privacy and control had to be sacrificed. And that's where you're seeing a lot of people trying, in my opinion, from a messaging perspective, to come up with newer solutions. We can talk about L2s, zero-knowledge proofs, all kinds of other mechanisms. But inherently in these permissionless chains, privacy and control is non-existent. So what we've seen, in 2015, 16, is the rise of private blockchains. And private blockchains said, well, we can't really allow everybody to see everything, and we need to have much more control and privacy in order to enable these applications. And that gave the rise to private blockchains. So think again, kind of when the internet got created, there was a lot of opportunity of how to share data more efficiently, but companies understood that they can't just put all of their information to the wider world without protecting it. And that's why when the internet got created, we saw a flurry of intranets. And those intranets were the equivalent of a private blockchain. But what we ran into very quickly, very similar with the internet, and we're seeing this in the world of private blockchain, is that this lack of interoperability, every network is unique. I need to connect specifically to every network, created a very bad user experience. And therefore they realized we need to have the internet, meaning everybody needs to be on the same internet, but without sacrificing privacy and control. And that's where you saw the innovation, and that's where you saw all of the protocols that started protecting data and allowing creators of websites to have much more control over the website, that not everyone can just have free access to their information. And that's really when we at Digital Asset thought about creating a public permission blockchain, we were very much inspired by, again, this direction of the internet, where from a user experience, you want to have one network, but you want to have complete independent application control, meaning me as a regulated entity that I want to put an application on a blockchain, I can define who has access to this application, under what situation anybody can see what information. And it's not just by default, if I put my application, everybody gets to see everything, or I have to create, for example, a roll-up or an L2, where within that small segment, everybody gets to see everything. That's just not the reality of how financial markets, especially regulated financial markets, work. But then again, without sacrificing the right-hand side, which is this native interoperability. So still giving this feeling and this user experience that you are part of one network, and assuming that you meet the regulatory requirements of an application, you could have native interoperability. And that's really where the name also Canton comes from. Our team is in Switzerland, so there's a bit of a heritage from there. But really the idea of Canton Network was this idea of the canton system in Switzerland, where you can have all of the cantons under one big entity called Switzerland, but they still have their sovereignty, but they can interoperate with one another. That's kind of the background of the name. So again, if I had to summarize really the features of Canton, is that all applications are sovereign, interoperable. You can compose smart contracts to one another, meaning I can do real DVP on the network. And the third one is very important, and that's really where L2s came into the play, is what we call horizontal network scalability. So if you think of Ethereum or the likes of Ethereum, they wanted to have all assets exist on one network. And from a computational and physical perspective, from our point of view, that just doesn't scale. And we've seen multiple issues when applications who were very popular at a time were able to kind of clog the network. So just imagine that we're going to do collateral management on Ethereum, and suddenly a JPEG application becomes very popular, and now I can no longer deliver my collateral on time because people want to buy JPEGs. That's something that, in our opinion, is not something that can and should happen. And therefore, this idea of horizontal network scalability is the ability to add more and more compute to the network as demand grows up, and not have an inherent design that says it's only when compute becomes faster that you will get more processing, or if you move from proof of work to proof of stake. You should just be able to just keep on adding more processing and more bandwidth to the network in order to grow with demand. And then again, the last one is what I talked about, the distinguished private chains, is that a node is a single point of entry, meaning you have a user experience as if you're connecting to one global network, even though the network is created from these interoperable applications. So with that, I think what we want to do now is I'll hand it over to Kelly. And again, what we wanted to show, and I think is important from a regulatory perspective, is to show how, when you have this ability to create these sovereign applications that can set all of their requirements in order to meet regulatory requirements, how can you actually create a better, more efficient financial system? Kelly, over to you.
Great, thank you. And just before I get into the pilot, we just pause for a second? Are there any questions from anyone on the setup information that
Kelly, I think we said since we're recording, we'll just go and then we'll do questions after.
Okay, got it. Great. Okay, so I'll get right into it then. Thank you. So as you've all said, what we wanted to do was organize a pilot of market participants, and to do it in a way that was going to emulate a real world market model. In a real world market model, we would each have our own applications. They might be similar. We might be providing comparable services, but different clients are picking different types of security services and post-trade services providers. So to be able to demonstrate that organizations can come together and act as they do now in a competitive, sovereign way, but to do that with interoperability that is achieved not through an old-fashioned message-based system with a reconciliation and cost requirements and the time requirements, but to be able to do that in this highly interoperable network that you've all just referred to. And to be able to do that and demonstrate specifically that the intended use of data across those applications between a client and a provider, or between the different providers of counterparties in a transaction, that the data is aligned to the type of transaction that they're doing, is permissioned in accordance with the legal agreements that support it. Manoj, my colleague, is going to talk about that in a little bit. And yet be able to achieve a higher order of scale and interoperability, of speed and consistency across the transactions, even though these transactions are very familiar to us, to be able to improve on that market model. 45 different organizations participated in this. I'll talk a little bit more about them on the next slide. There were 22 different permissioned applications in the pilot, in the simulation of a real world network. There were 6 or 7 different specific types of applications, and I'll talk through those, but 22 different instances. So we had, say, multiple custody applications running, which again mimics the real world scenario. 33 different participant nodes. This is that single point of entry that you've all referred to a moment ago, where the investors or the underlying, say, hedge fund clients of a prime broker, or the investors of a custodian, or the clearing members of an exchange could be participants in one or multiple of those applications. There were 155 people that joined us to do it, so we were really thrilled to have arguably the brain trust of some of these services in capital markets, providing very lively commentary and really good insights on what worked and what didn't. And in total, about 350 transactions processed across the week in December where we did these simulations. If we go to the next slide, you could just see quickly at a high level, if you look closely, some of the names of the participants. About half of them allowed us to disclose their name. What was meaningful about this one is, I think that for a lot of the analyses that have gone on in the marketplace to date, they're quite rightly emulating from the providers of those services, the custodians or exchanges. What we were trying to do here, and what we were thrilled to have happen, is that the underlying end beneficial owner of either the assets or the obligations, say in a margin call, were very active, and actually were the larger numbers in this. All source of new demand in the industry is going to come from the entities that are owning those assets, or providing the cash activity around those assets. And so getting those meaningful numbers into that, we think, was unique in the pilot, but also really meaningful to provide those comments that I referred to and the feedback that I referred to, since in the end of the day, ultimately the responsibility for paying for and bearing the risk associated with any market solution or any solution is ultimately for the entity that is owning the asset or owning the obligation. So 15 asset managers, 13 different banks, 4 global custodians, which very much models the way the world works, 3 exchanges, and 1 entity that served as a central securities depository and FMI. Each of these entities could play one or more roles in the pilot, which is why it gave rise to a much larger number of transactions than you see entities here. Okay, so that's an overview of what it was. Manoj, do you want to take a minute and just talk through some of what we were focused on from a legal and policy matter in demonstrating?
Sure, and even piggybacking off of what you've all said at the beginning, from the beginning of this company, we recognized that for blockchain to work in a regulated financial system, you needed to ensure that every participant had control over key aspects of the transaction, from access to knowing who you're dealing with. And we're seeing that, it's been encouraging for us as the regulatory frameworks around tokenization and tokenized traditional assets come into focus. We're seeing this convergence between how we've approached the problem technologically and how these frameworks are being developed. There's, I think, a tendency to think, well, a tokenized traditional asset, it's the same thing as the underlying asset, so your regulatory framework should be the same. You don't really need to think too much about what's going on. But what's been great, I think, especially with the Basel Committee on Banking Supervision, is they've recognized that, well, that's not quite the case. And given what's happening to an asset when you tokenize it, and because you're not just, changing the representation of the asset, but you're embedding all of these workflows into it, how those workflows are carried out by the underlying blockchain technology impact the risk profile of the asset. And so with the Basel committees, you saw that in their final crypto asset prudential standards from December 2022, that one of the classification conditions to determine the capital treatment of the asset is, well, how much control is the underlying blockchain technology providing you over these key aspects that you see here? That's what we refer to as SC06C. And with the pilot, we really wanted to show that, there's an alignment between how we're solving this problem technologically and how regulators are beginning to think about this from a risk perspective. So you see that with the controls, you see that with privacy, and on the composability side too, as regulators, as we hear the benefits of tokenization articulated, one of those is interoperability, like you've all said, and the composability that goes with it. So you need to be able to show the control on the one hand, but you also don't want to sacrifice interoperability and composability to get that control. And I think, as Kelly will talk about in the next few slides, that we were able to show both at the same time.
And just to add on, thank you, Manoj, just add on to this. As we think about controls, privacy, and composability, some of what I was referring to on the prior slide in terms of how it was set up, the market participants who joined us were able to, in part of the prep, influence what they would be in control of or what their app would mimic. Now, this is a pilot, so it wasn't a full production solution, but for each of the participants, they were able to choose the different applications that they wanted to run. And as I said, some could choose multiple because, say, a bank could reasonably have multiple roles in the market model that we were emulating. But what we did is we worked with them to make sure that at a pilot level body of work, we could understand, are there certain types of controls that they would want to be able to influence in the user journey or the use case story that we were walking through? Or is there a way of having certain approvals or evidencing finality of settlement and the data and the information that might be available to them? Is there a way of informing a transaction on the AML, KYC, and other information in that process? Now, I realize we're talking to regulators, so we didn't go to a full scale set of activity that would be required from a production solution. But what we wanted to do was give them something that was real world that would allow for them to provide that color commentary that they did. And so that's what gave rise to the types of applications that we ended up doing. If we go on to the next slide, I'll just talk briefly about the 2 main scenarios that we walk through. Now, in the lead up to this, we had as I said, had a conversation not only with the market participants, but with some of the industry regulatory and self-regulatory or associations that that we have the pleasure of being involved in, to just try and understand what would be most indicative or meaningful to be able to demonstrate. I think that you know, there's a lot of conversation about using tokenized money market funds for margin calls or meeting margin calls, but we wanted to get really sort of deeply into each of these use cases and be able to evidence something that was not so high level as to not allow for meaningful insight and comment. So in the first scenario, what we were aiming for was one of the pieces of feedback that we had received, particularly from the exchanges that were involved, that they allow for money market funds to be delivered in as a variation margin, but it's not being used to a greater degree than cash. And why is that? Particularly in a rising interest rate environment, will cash be less attractive to meet those intraday margin calls? And can we get the efficacy of money market funds to be higher so that they could be used more? So in that first scenario, the margin call was met by the investor using a tokenization application, a trading application, to request the creation of shares of a tokenized money market fund, to have that become available for immediate use intraday to meet the margin call with their prime broker or a prime broker on behalf of the exchange. And then we had the margin app that was being run by the exchange and received by the investor model and change that during the course of the transaction. So it was mimicking several days of activity where the variation margin would change and the amount of margin would be adjusted by either calling for more or returning some of those tokenized money market shares. It goes directly to the point that Yuval was making earlier about this being a true DVP, where the ability to meet that margin call, the delivery on it, was instantaneous to the creation of the asset that was being used for it. So a great degree of discussion around this on the degree of capital efficiency improvement, the degree of collateral allocation and eligibility schedule improvement, and the costs associated with that. You can read more about that in the pilot report that came out. In the second one, we used a more common model that's used in the marketplace today, which is to use the repo transaction to raise cash to be able to meet the margin call. One of the reasons we focused in on this, and for any of our regulators that are representing the UK side, one of the reasons we focused in on this is we had a deep level of conversation with some banks and some exchanges to be able to understand the ability to meet margin calls intraday, reflecting on the September 22 gilt crisis. So those were our two examples that we went through in some detail. And as I said, you can read about them more in the pilot report. And then I think Yuval, just quickly, when we do these pilots, we want to be able to make sure it's not just simply about the technology and about demonstrating how assets can be tokenized and the services are on them. We're constantly asking ourselves the so what of each one of these. And so there were a handful of industry topics. Manoj had touched on them, but a handful of real world industry topics that are much in the news right now that we wanted to be able to make sure we were touching on and having some depth of discussion around. T0 issuance, you've all talked about that at the beginning, and the ability to be able to more cost effectively meet the requirements of a T+1 and a T+0 environment, T+0 particularly for those in Asia. Also the ability to reach new channels, to be able to use these networks to have a better distribution model, increased liquidity. These are the securities financing transactions and the repo transaction that we modeled. Embedding in these tokenized assets the automation of their life cycle events so that corporate actions, proxy voting, and those activities can be done with lower risk and greater efficiency. Intraday margin, I talked about that a minute ago, and atomic settlement, the ability to have certainty and finality in a true DVP model. And it's these last two, intraday margin and atomic settlement, that are going to be the subject of some follow-on pilots that we will be doing, a chance for us to delve a little bit more deeply into how those can be done with more asset types and more real-world assets coming into the model to be able to demonstrate efficiency overall. And with that, I think now the next slide, Yuval, is back to you to talk about the key takeaways.
Yeah, so I think that one of the last thing is really we've done a bit of a survey at the end, and I think that one of the things that we've seen, I think you see the three key takeaways which align, and this is really from the participants. I think a lot of people talk about interoperability, but I think that interoperability comes from the value of connection, meaning where there is real value. And I think that may be an important statement, because I think a lot of people think that interoperability is not possible. I think that interoperability is a technology problem that is very solvable. But at the end of the day, it's from participants in the market, it's not worth making the investment unless there's a real opportunity. So for example, if one of our exchange clients had a regulatory approval to use Ethereum as eligible collateral for their clearinghouse, I can assure you that we would be able to do interoperability with Ethereum. It's really that you need to show real value in order to solve for some of these interoperability points. Tokenization requires connectivity and control. I think that most of the tokenization examples that you've seen on permissionless chains, most of the issuance actually happens off-chain, where the asset itself on-chain is just an IOU token, meaning it's a claim against the traditional asset. And then the buy side is really buy-side interest is on the rise, and we're seeing they're seeing high returns, so there's quite a lot of interest. Maybe before we open for Q&A, as Kelly mentioned, there are a few other pilots that we're doing. There's a few regulators that are already asked to be observers of those. If there's any interest from the participants here to be involved in those two pilots that are coming, one in the US and one in the EMEA region, please let us know, and we would be happy to accommodate you. So with that, Emma, if we want to stop the recording, and happy to open for Q&A.